We're hearing a lot of talk now about the economy. Whenever you hear talk about the economy, we always notice that the Federal Reserve, this phrase, the Federal Reserve, comes up. Because the Federal Reserve is so instrumental in what happens to our economy, what happens in your financial life, in so many different ways. And I think most people don't understand the Federal Reserve. They have total misconceptions about what it is and what it isn't, how it came about, the legality and constitutionality of it, and does it have too much power. So let's talk about the Federal Reserve. We're going to do a little bit of a course on it today, maybe some follow-up next week. But the Federal Reserve is the central bank of the United States. And it is not the first central bank of the United States. As a matter of fact, it's the third central bank of the United States. The first Bank of the United States was 1791 to 1811, 20-year charter. And then it was shut down. And then you had the second Bank of the United States that came in 1817 to 1836. And then in 1913 is when the Federal Reserve came about. Now, why did it come about? Well, officially, the statement is that we had a series of financial panics, notably 1907. Where banks were on the verge of closing and so forth, and people's savings were getting wiped out. And these crises seem to happen every 20 years or so. So it was the thinking that if we have a central bank, it'll have the ability to stabilize the financial system. Now, people think with the word federal in it, Federal Reserve, that the bank is part of the U.S. government. It's part of the government of the United States, which is totally incorrect. The Federal Reserve is no more part of the United States than Federal Express is. And isn't it nice that they use the word federal to get it in there, to make people believe that this is your government? And it's not. The Federal Reserve is actually privately owned by other banks. And I'll tell you who those banks are in a second, because most people don't know. And they were formed in 1913. There was something called there's a book out called The Creature from Jekyll Island, and it's about the formation of the central bank, the Federal Reserve, and how it came about, and who was instrumental in it coming about. And it was kind of like a scheme. They started getting together. I think it was 1910, discussing how they could take the power of the currency, the creation of the currency, from the Treasury to the banks themselves. And we'll talk about why that's such an important thing and why financially it's so important. And one guy that's very instrumental in it was a senator called Nelson Aldrich. He committed to ramming this through. He had a very, very close relationship with the Rockefellers, who pushed the Federal Reserve Act. And it was passed a day or two before Christmas, where half of the Congress wasn't even there. And it was signed by Woodrow Wilson, and what must be probably the worst piece of legislation ever created. And I suggest reading the book, The Creature from Jekyll Island, and you'll learn the whole story and how sordid it is. Now, a few of our presidents tried to stop central bank from working. Lincoln, Andrew Jackson, he was totally against central banks way back in the day. John F. Kennedy, he tried to stop the Fed by printing our own currency. For a while there, he printed U.S. dollars, not having the Fed print it. And you could imagine how the moneyed interest, the banks, felt about that. Hey, no, we usurped the power from the Treasury. You can't do that. And look at what happened to JFK. He didn't last very long, did he? Money is power. And these people know it. Now, Article 1, Section 8 of the U.S. Constitution states that Congress should have the power to coin or create money and to regulate the value thereof. It's It's night and day, right? It says it right there. It's couldn't be more clear. Section 1, Article 1, Section 8 of the Constitution states that Congress shall have the power to coin money and regulate the value thereof. Today, though, the Fed, again, which is a privately owned company, controls and profits by the printing of money through the Treasury and regulating its value. And the way it's regulated its value is to diminish its value year after year after year. And they make up, they're the head of an international banking cartel whose wealth is beyond comprehension. You couldn't even imagine how much money is involved here. And Congress illegally gave the Fed the right to print money. And they do it. And they've done it to the point of trillions and trillions and trillions of dollars. So who actually owns the Federal Reserve Central Bank? There's 12 different banks in the Federal Reserve System. There's regional banks, and then there's the Washington-based main Fed. And a lot of these individual banks kind of operate pseudo-independently. They have their own board of directors, they have their own shareholders and stuff. Now, the ownership of the 12 regional central banks is a very well-kept secret. Not too many people know this, but it has been revealed recently in recent years. And a lot of these are foreign banks. Rothschild Bank of London, the Warburg Bank of Hamburg, Germany, the Rothschild Bank of Berlin, Lehman Brothers of New York, when Lehman Brothers was around, Lazard Brothers of Paris, Kuhn Loeb Bank of New York, Israel Moses' Seif Banks of Italy, Goldman Sachs, there's our old friend, Warburg Bank of Amsterdam, Chase Manhattan Bank of New York. So more than half of these banks that own our central bank are foreigners. And many of them are connected to the London banking houses, which ultimately control the Fed. And the problem with the Fed is they're not elected. And they have more power than the president. They have more power than Congress. And they can control the cost of money. And why is that so important? Well, their mandate, they say, is to keep full employment and low inflation. But they've gotten off of that mandate and start doing so many other things lately. Like propping up assets, the stock market, so forth. Buying bonds, keeping interest rates artificially low, creating monetary inflation. And what they do is, the first thing they do is control interest rates. How do they do that? Well, they do it through what's called the federal funds rate. Well, the federal funds rate is the interest rate that banks charge each other for overnight loans. Well, what do you mean an overnight loan? Well, banks have to have a certain amount of reserves at the close of business put aside based on how much deposits they have and so forth. It's a complicated calculation. Now, some banks don't have it. They're short. And some banks have more than they need. So the banks that have a surplus of reserves lend it to banks that are short. And they lend it to them overnight and they get the money back in the morning, satisfying the reserve requirement of the Fed. And they charge interest on that. Well, the Federal Reserve controls that interest rate. Now, historically, that interest rate is 4%, 5%. But over the last 12 years or so, it's been less than 1%. And right now, the target interest rate for the federal funds rate is 0 to 0.25%. That's what happened last year at the beginnings of COVID when the Fed took down the federal funds rate to virtually 0. Now, that's important because all other interest rates are tied to that. The prime rate, you've heard of the prime rate before. That's the interest rates that good customers get, and it's relative to what the federal funds rate. They tack on a premium, usually about 3% or so. So if the prime rate's lower, credit card rates are lower, at least theoretically, at least for good customers. Mortgage rates go down. car loan rates go down, government borrowing goes down as far as the interest rates go. We'll talk about government debt in a little bit. It's very, very interesting what's happening with government debt and interest payments on that debt. And it's not what you would think. So they can control interest rates in the economy, and if interest rates are low, that's called an accommodative posture. That's it's called. They talk about a dovish stance. That the Fed is going to keep interest rates low, provide a lot of liquidity into the system. Well, when you have that, it's great for the economy. When mortgage rates are low, more and more people are buying homes. Companies are expanding because they can borrow money cheaply. They're hiring people. And when you're in a recession, what typically a central bank will do is lower interest rates to try to turn it around. But the problem with doing that causes inflation. Whether it's the stock market, whether it's the bond market, whether it's the commodities market, real estate, energy, wages. Cheap money does that. So there's no free lunch here. Otherwise, central banks would just keep interest rates at zero forever and just have a robust economy all the time. And the problem with low interest rates, sometimes the economy overheats. What does that mean? It grows too rapidly. And when it grows too rapidly, it causes inflation. And that's what we're in the grips of now. In an inflation because of the stimulative low interest rate policy of the Fed, the printing of money through quantitative easing, which is another thing that the Federal Reserve does. And quantitative easing was something I never heard about prior to the 2008 great financial crisis. That was a new word to me and many people in finance. Quantitative easing, what does that mean? Well, it simply means that you buy up assets from Wall Street, put them on your own balance sheet in your own account, create the money to buy them. And by doing so, what you're doing is you're injecting money into the system. So the banks have cash instead of having bonds. That cash then theoretically goes through the economy, into the stock market, into the real estate market, and so forth. And the Fed has been doing quantitative easing in one form or the other since the financial crisis in 2008. It's 2021 right now. So we're talking 13 years of historically low interest rates and quantitative easing. And that's the reason why the Fed's balance sheet has gone from $600 billion prior to the 2008 crisis to over $7 trillion right now. That money is created and moved into the system. And now we have a substantial acceleration of the quantitative easing and government debt because they go together. In March, the total national debt hit an all-time high of $28 trillion. And why did it go up so rapidly? Well, the CARES Act, which was $2.2 trillion in March of last year. Then you had the Consolidated Appropriation Act in December of last year, $2.3 trillion. And most recently, we had the American Rescue Plan, $1.9 trillion. And now the infrastructure bill is the next thing, the multi-trillion-dollar thing. We'll talk about that later, the bipartisan deal, but we'll see. It's a wolf in sheep's clothing. And we'll see how the Republicans may have fell for a quick one here. Talk about that later in the program. So they can control everything, the Fed. And that means they can control your life. They could force you to pay higher mortgage rates when you buy a house. Their actions through inflation can cause the price of a house to go up so much that you can't afford to buy it, which you're seeing now, especially for first-time home buyers. Boy, it's nice if you own a home right now. I mean, the prices have been skyrocketing. But it's not so good if you're looking to buy a home. And again, by Fed actions, whether it's zero interest rates, whether it's quantitative easing and printing of money, it is inflationary all the time, every time. So how do you fight inflation? Well, what a central bank will do, and what the Fed has done in the past, although they're not doing it now, is when they get the whiffs of inflation, they get the whiffs of an overheating economy, they raise interest rates. They slow down their quantitative easing, or they stop it altogether. Well, they do the opposite. They start selling bonds. Instead of buying them from Wall Street, they sell them. And by selling bonds, that takes cash out of the system and tightens up monetary policy. And the most extreme measure of this was in 1980 when Paul Volcker, then chairman of the Federal Reserve, was dealing with Jimmy Carter inflation of around 15%. And by the way, if we calculate inflation the same way they did back in Carter's day, we're about 11. So we're not that far behind. But unlike the Fed today, the Fed then jacked interest rates up aggressively. Where the Fed funds rate was something like 18%. It's zero now. Quite a difference between fighting inflation back in 1980 and fighting inflation in 2021. And by the way, inflation is accelerating now at the highest level of all time. It's not at the highest level, but it's accelerating. It's going up very, very rapidly, the rate of inflation, like we've never seen before. So instead of doing what they're supposed to be doing when you have a growing economy, they're saying that, the first quarter GDP was 6.4%, I believe. Economists are predicting that the second quarter numbers, when they come in, will be something like 12% annual growth. I mean, if that's indeed the case, that's a hyper economy, an inflationary economy. As states open up and cities open up and people start going back to work, I mean, this is all spurring more spending, more asset speculation, and everything else. Again, one of the key ingredients for inflation. So instead of tapering their quantitative easing even a little bit, they've stated multiple times just recently, just last week, that they're going to continue it probably through 2023. And although in the previous Fed meeting they said maybe in a year and a half they may raise interest rates twice, 0.25% each time, to 0.5% from zero, markets didn't like it. Stock market sold off, commodity market sold off. All because the Fed even mentioned the possibility of raising rates 0.5 point in a year and a half. If that's not the recipe for hyperinflation, if not regular inflation, I don't know what is. So that's a central bank. I mean, it is unconstitutional, most people would say. I mean, I read it to you. Article 1, Section 8 of the Constitution states that Congress should have the power to coin money. It doesn't say that they could take that power and give it to somebody else. And the reason why we're $28 trillion in debt is because of the creation of the Federal Reserve. If we printed our own money, we wouldn't have to borrow anything. Yes, that could be inflationary too. You print too much money. But we print money and we spend our money. We don't print money and create bonds that we pay interest on. See, the Federal Reserve has the ability to create money with no interest. For us to create money to fund our deficits, we have to borrow it at an interest rate from the Federal Reserve. Now, apparently, the Federal Reserve is supposed to, after they pay all their expenses, whatever that means, which could be everything, is supposed to return to the U.S. Treasury any excess profits that they have. Now that's important because it's been very useful in keeping interest rates or interest cost on our outstanding debt lower than it is. And the Fed has been buying more and more and more of our bonds. So theoretically, they have to return the interest, so that's interest that cancels out. And now they've been coming in and buying longer-term bonds. Why longer-term bonds? Because longer-term bonds pay a higher interest. So if they buy them up, they return that interest to the government. So even though our debt has gone up quite a bit over the last 10 years, the actual interest service on the debt has actually stayed about the same. Up to now, anyway. Another problem that the U.S. government has right now is that much of its $28 trillion in debt matures over the next 2 years. and has to be refinanced. I mean, it's never paid off. They just roll it over to issue new bonds to pay it. And the risk here is that if interest rates go up over the next couple of years and we have to refinance tens of trillions of debt at higher rates, now all of a sudden we're going to see our budget deficit explode as our interest costs go up. And that's the real risk here. So the Federal Reserve is not the only central bank in the world. Japan has their central bank, and they've been doing the exact same thing, quantitative easing. You know, the Central Bank of Japan is the biggest shareholder in almost every major stock on a Tokyo Stock Exchange, in the Nikkei, and hold tons of bonds. You have the European Central Bank. Operates similar, pretty similar to the Fed, but has different restrictions because there's a number of countries involved in that. So the president picks the Federal Reserve chairman. That's about the only influence that a president has on the central bank. Now, you know, the president, you know, has a bully pulpit, and he could try to talk down the Federal Reserve and try to get them to keep interest rates low. Presidents and administrations never want to see interest rates go up because they want to see the economy do well. And President Trump was one of those big outspoken people about the Fed, which may have been influential in them keeping rates down, which also means that it's influential in the coming inflation that we're dealing with. But every president doesn't want the Fed to raise rates. Nixon brought in the Federal Reserve chairman at the time, I forgot his name, and begged him not to raise rates. Brought him into the White House and begged him. So the Federal Reserve is usurped the authority of the Treasury by having the ability to print our money, charging interest on that money. They now have abandoned their main decree of battling inflation because they can't stop the quantitative easing because the U.S. government's budget deficit continues to explode. This is going to be the biggest year in history for our country. We're already at, I think, $2.7 trillion. And by the end of the fiscal year, at the end of September, we're probably going to be about $3.5 trillion, depending on what passes as far as infrastructure and all these other bills that they want to do. So they can't stop quantitative easing because they're the ones who are buying 70% of all the new bonds being issued by the federal government. Because nobody else wants them at these rates. Do you really want to buy a 10-year U.S. Treasury bond that's going to pay you 1.5% for 10 years? Do you really want a 30-year that's going to pay you 2.09% for 30 years? And not to mention the principal risk you have, because when interest rates go up, bonds go down. That's why it's the Fed that's buying almost all of them, because nobody else wants them, and the only way they would take them is if interest rates were substantially higher in the bond market. And if the Fed wasn't printing $120 billion a month and buying those bonds, interest rates would be creeping up drastically in the bond market. And when that happens, interest rates across the board start going up, the economy starts tanking, the markets start tanking, we got a big problem. And there's nothing more powerful in the world right now than the Federal Reserve of the United States. It controls everything. Not only here in the United States, but in the world. Back in the 2008 crisis, not only did we bail out U.S. banks, we bailed out foreign banks as well, to the tune of something like $11 trillion. It was nuts, and it was secretive. And this evil central bank, and I call it that, has robbed this country of enough money that we could pay off the national debt. And the problem is the Federal Reserve is powerful, can create as much money as they want, could buy politicians like they did back in 1913 to get something that is totally unconstitutional and not in the best interest of the country. passed on Christmas Eve. Now, the Fed's moving towards a cashless society. And that just means the banking system can control you even more. Know everything you spend money on, every person who gets paid something from you. And they're in the process of doing it now. I mean, it's called FedCoin. Or digital dollars, they're calling it. But they're going to roll that out probably within the next year or so. And the way it's going to work is that, they're going to tell you, we're setting up an account for you with the Fed. We're going to put some money in it now. You have to activate it. And then in the future, everything will be transacted through that account. And that allows the Fed to, if they want to do helicopter money and stimulus money again, they'll just print it and put it right in your account. It won't go through the IRS like it's doing now. The problem is, at that point, they could really start controlling you and telling you, okay, we just put $1,000 in your account. It's going to disappear in 30 days unless you spend it on X. Maybe they want to influence a certain area of the economy. We're going to put $10,000 in everybody's account, but you got to spend it on a down payment on a house. And the question is, what if they feel that you're not on the right political side? Can they take money out of your account and say you can't spend it? You can't spend money on guns. This digital account won't allow you to spend money at a gun manufacturer. And we're seeing that now with PayPal and all these other organizations. Shutting down accounts of people who are trying to either buy guns or trying to finance conservative organizations or whatever. It's all about control. Now, if I was a Bitcoin holder or any other digital currencies, I'd be really worried about this because the Federal Reserve is not going to allow competition for their federal coin. Now, there's also talk that this will be a major redistribution of wealth. What do I mean by that? There's been some talk that if you're very rich, your $1 million in cash in the bank account may only get 40% of the new Fed digital coin. Whereas if you're a lower income or some other status, whether it's racial, gender, or whatever, maybe you get 110%. Talk about an instant transfer of wealth. Now the question is, would this hold up in courts? Is this constitutional? No, it's not. Nothing's constitutional, but does it matter anymore in this country? I'm going all the way back to 1913. It was unconstitutional to set up the Federal Reserve. And nowadays, does the Constitution mean anything? For a long time, the Constitution has not been enforced. So central banks are more evil than people understand. They steal the wealth of a country. They have more power than the government of your country. They're unelected. They could destroy the economy. They could destroy your family's wealth. They could eat you up in inflation, which is going on right now. Now, before the central bank was set up in 1913, we had very little debt. In 1910, our debt was 10% of GDP. Now, 1913 is when the Federal Reserve was established. By 1920, we had a 23% debt to GDP ratio. In 1930, and that's the beginning of the Depression, we had $16 billion in debt, which was 36.4% of GDP. By 1940, debt grew to $40 billion. Now, $40 billion compared to $28 trillion today is like a drop in the ocean. But still, it's all relative. So in 1940, we had World War II. All right, and we spent a lot of money, obviously. They say it was the equivalent of like $4 trillion in today's dollars. So in 1940, our debt went up to 75.1% of GDP. Through the decade on average. By 1950, 10 years later, that went from 40 billion to 257 billion. But it dropped because the economy grew. After World War II, we had a boom in the United States. As soldiers came home, they got married, bought homes, and manufacturing skyrocketed. So even though we went from 40 billion in debt to 257 billion in debt, it dropped from 75% of GDP to 56.8 because the GDP grew more than the debt did. By 1970s, $371 billion, but only 26.1% of the GDP. 1980, we're getting really close to our first trillion. It's $908 billion, 33.7% of GDP. But look what happens 10 years later. We go from $908 billion to $3.2 trillion. Now debt and deficits are skyrocketing. But we're still at a relatively manageable 33.7% of GDP. That's manageable. That's debt that's manageable. You stay under 70, 60%, it's not too bad. But in the 2000s, we go from 3.2 trillion to 5.7 trillion, 36.6% of GDP. And now we have the great financial crisis. And we go to the 2010s, $13.56 trillion. And now we're moving up to 72.4% of GDP. Now it's starting to get concerning. And in 2020, $27.7 trillion. Now we're at 106% of GDP. Now we're at crisis levels. We're at levels that guarantee a major inflation problem and major economic problems going forward unless we get this under control. Now, it's predicted that by 2030, we're going to be at 122% of GDP. By 2040, we're going to be at 165% of GDP. And then 2050, we'll be at 195% of GDP. This is unsustainable. We're not going to be because it can't happen. The economic turmoil and craziness that would happen there would be crazy. So again, central banks, a lot of power, probably unconstitutional, run the world, steal the wealth of the country, and you and I have no say whatsoever about it, and we just have to live through it, and the government's allowed it to happen. Let's take a break. 732-505-1160 is the call number. My name is Lou Scatigna. You're listening to The Financial Physician. Don't go away.